buying habits and also what people want with the new technology is changing too. So I think there's a massive market in small multifamilies, rentals in the Midwest. I really think that, these kids are moving up. Maybe they don't want a home. So I think the market is in, 4 to 6 to 20 multifamily, I think is a sweet spot.
Yeah, it really is. 4 is nice because you can house hack it, or you can, still get a traditional 30-year loan on it, with low down payments and everything like that. Above that, 5+ units fits into the commercial. I love that because then you're valued less on comps and more on your, NOI. So we can have a lot larger impact on, value appreciation, forced appreciation.
So break that down for us, for anybody that doesn't understand the difference when you get off comps.
Okay, yeah. So 4 units and under, traditional loan. So you're going to go buy your house. It's going to be $200,000. The appraiser is going to come in and they say, okay, there's been 6 houses that have been sold within the last year that are, plus or minus 10% of this price. Great. It's worth $200,000. The bank says, okay. You go to a duplex or a fourplex, 4 units and under, it's going to work on the same process. Hey, these other multifamilies have sold, they sold for $200,000. You want to buy 2 for $250,000? Sorry, that's a no-go. You get 5 units and over, that falls into a commercial loan. So the commercial loan, then they're going to look at the sales approach, right? So they're going to look at comps. Hey, other 20-unit complexes or sets of fourplexes have traded at X dollars per door. You got 20 units, $50,000 a door. Okay, $1 million. Great. But then they say, okay, let's also look at the income approach. And they're going to say, okay, based upon the current income of, let's use a number, $10,000 per month, $120,000 per year, divide it by the cap rate. Okay, here's what this property is worth. Okay, based upon its current income, it's worth $950,000. Well, if we're able to push that rent $1,000 a month, $12,000 a year, divided by the cap rate, then maybe it appraises out at, on the income approach, 1.05, 1.1 million. Mm-hmm. So then you have additional equity. So then you can get to a refinance faster, or if you want a sale, then you've got more proceeds on the sale.
No, and it's amazing because when you step into the multifamily world, when you get above 5 units and you get to 50 or 60 and you change some things, you put the waters on the tenant, you remove rents. I mean, guys, we're not talking about a couple $1,000. We're talking about $2,000 or $3,000 or $4,000 or $5,000 or $6,000 pushing what you said, the forced appreciation. It's very, when you understand the vehicle of multifamily, it's you can understand why everybody's so excited about it.
Yeah, it's really great. And kind of circling back, having a sophisticated property management company coming in, that's the service we provide, right? Somebody's like, hey, I'm looking at this 20 units. What do you think? I think here. But then we get the rents to market rents. We add pet fees. We add common area fees. We add a RUBS. Okay, you're going to increase your income by this month, by this much per month, times 12 months. Hit the realtor up. What's the cap rate here? Okay, it's an 8%. Okay, it's a 6.5%. Divide that by 0.08, 0.065. Boom. There's $137,000 in value we just added to your property. Mm-hmm. Great. Now you've got 15% more equity.
I love it.